the cost of doing nothing could crush your growth of your portfolio, crush your yield of your portfolio, and you're never taking advantage of the volatility of the market. All right, so let's jump into the power of rebalancing. This is a fun topic to talk about today. But before we jump in, Kyle, you wanted to say something?
Oh, sorry. If you like calm and steady investment advice, subscribe to our channel. We're here to keep everything calm and steady for you. I'm just kidding. It's actually a lot harder to keep a straight face on that.
Calm and steady.
Dude, just trying to introduce the show and you're sitting there like this. I'm trying not to laugh right now. Because I'm thinking to myself, how many times has Kyle ever done this? And I'm thinking
never in a serious place.
All right, so let's get into the power of rebalancing. This is a fun topic because this is a topic that I don't think most people think of very often. Because most investors buy for growth, even dividend investors. Like, I want the income, but I want to buy at X and sell at Y. And they're not necessarily thinking, well, every single year that goes by, I want to adjust my portfolio.
No, when they think by adjusting, it means I have to change positions. It's not, I can adjust my portfolio, keeping all the same positions, just, as you always say, reshuffle the deck.
Reshuffle the deck.
And rebalance. And that is actually, which we'll talk more about, can be way better than even changing the positions.
Yeah, because the act of rebalancing is no sell alls or no buy news. So there's no new position in the portfolio, and there's no position we're going to sell out of. And we're just going to take our positions, however they landed at that point, and realign them to an even playing field.
That's right.
So if we had 25 positions in the portfolio, we're doing 4% per stock, and we've got some stocks are at 6%, some that are 2%, whatever it is, because they all went different directions. The moment the market opens, it's like scatter. And all of a sudden,
only at the rebalance are they equal. And then it's literally
one time for like 1 minute, and you hit the rebalance button, and it's never specific because you've got crazy variety in prices. You might have a stock that's trading at $18, a stock that's $80, a stock that's $250, a stock that's $900.
Correct.
And you're like, okay, I have this much value, get it to 4. Sometimes you can't.
Right.
Sometimes it's 4.1 is the closest we can get to 4. Sometimes 3.7 is close we can get. So it's still kind of crooked.
Yes.
That line, but it's as close as we can get because of the share prices.
That's right.
Right?
Yep.
All right. So let's jump in. The first part I want to talk about, what would be the biggest reason for a rebalance?
Well, it's that forced buy low, sell high. Because just like you were just talking about, inevitably, as soon as you balance your portfolio, invest new cash, or you're just coming over, we get it set, the market opens, and they scatter. And they're doing their own thing. And whenever you allow a couple of months to go, you are going to have some that are just really taking off. There's some winners, and there's going to be a few that are just kind of lagging behind. So if you can kind of revisit it, a couple times throughout the year, really assess if this is going to be the time, you force that buy low, sell high.
So when stocks go down in price, what happens to their yield?
It's an inverse relationship. So their yield actually increases. The share price has dropped. Think of it as on sale. Now you're able to actually go and buy more shares of that company.
So we have a stock at $100, another stock at $100, wherever you can see me. And one stock goes down to $80, one stock goes up to $120. Okay, so we still own the same value because one's up 20, one's
same
down.
Number of shares.
Yeah, same shares, same overall value, assuming they were both $100 at the price, at the buy price. Now we're out of whack. This yield, the one that went down, has a higher yield.
Correct.
This one has a lower yield, but now we're changing the shares. We're selling this at a 20% profit, and we're buying that same 20%. We're now putting down in here. So we earned more shares here at a better yield.
Right, at an increased yield.
And we sold some of our shares here at a higher yield. So we locked in this gain at a lower yield, and we took that lower yield and we purchased it in a higher yield at a lower price point. So by doing this rebalance, we're locking in gains and we're taking care of advantages or opportunities at a lower price and a higher yield. So there's some research by tons of companies out there. Two that we're going to talk about. The first one we're going to talk about is Vanguard. And in Vanguard's research, now Vanguard, this is the interesting thing. Vanguard's a mutual fund company. And I can't talk about the inner workings of how they do what they do.
Yep.
But in their research, they have said, and this is published, and we can put a link in the show if we want, but the returns are the same or better in their studies. So from a total return standpoint, the effects of rebalancing are going to give you the same return or slightly better. So from a return standpoint, and this comes from a mutual fund company, not an individual managed account, which we're going to talk about in the Delbar study, completely different data.
Correct.
But on a mutual fund perspective, and the reason why this is more
professionally managed, they got all the analytics, they got
hundreds
everything.
of thousands of
millions of data points.
Yeah, crazy. Same or better return, lower volatility, and better control in market cycles.
Yep.
So across the board, better.
Yes.
Check.
If you're getting the same return, lower volatility, lower risk, that's our responsibility to our clients, right? Like I just got tested on that. My Series 65.
That's an interesting thought process there. Because you could argue, because I can show you some research and you'd have to cherry pick, but I can tell you some positions that if you never sold them, you would have a better yield, more income because of the compounded nature of what that stock did. Again, you'd have to cherry pick. So when you're talking specifically about your fiduciary obligation, that's a tough call. And I know you just got licensed, and sometimes the testing world and the real world contradict each other, because I could actually give just enough equal research to talk against rebalancing.
I mean, I know of one of our positions right off the top that I could say would almost debunk that.
Altria. Yeah. But that was way back in the 70s, 80s, and 90s.
But even if you take it from a 20-year span, I just did it with a client, taking it from 2000, because they're a younger client. I'm like, let's just take the last 25 years. And it's still mind-blowing.
Crazy.
Yeah.
So I would say from a stepping back standpoint, with the positions that we hold, statistically, it's better. We can argue all sides of this with specific cherry-picked positions, you know, because now there's going to be people going, what was that stock again? You know, rewind that.
Yeah, right.
What was the past? What was in the past may not be the future.
Yes.
And I'm sure we could pick 30 other stocks that did not outperform like that.
Right? Yeah.
You did nothing and you just sat there and...
Well, we can look in our portfolio and I can tell you certain positions in our portfolio, because of the rebalance that we've done over time, exist because of the cash that we generated from profits of certain. Because I've got clients that have called me and say, you know, I have actually no original money, like Nucor would be one.
Yep.
I have no original asset that I invested when we bought this stock. I've sold more than I originally invested, and more than like the second time.
Yeah.
Like, let's say I put in, you know, $10,000. I've sold $25,000 worth of that position, and I still have, you know, let's just say 18,000 in the position. I've sold 20-some thousand. So these positions over here exist because of that one.
Yep.
Which is crazy.
It's fascinating.
And that yield is terrible. When you look at it, you're just like, why do we still hold that? We've made so much. Like cumulatively, you need all sides of in a portfolio.
Correct.
You need a strong income. You also need growth, because that growth adds, because what we've taken with that terrible yielding high growth stock, we were able to buy really good income that wouldn't exist if we never had that.
Yeah. It just hasn't had like down years. It's in an industry right now in steel that is just thriving and for the foreseeable future, and how they do it with recycling and renewable steel.
Awesome.
Like it's just, it's the type of company you wish you could create an entire portfolio around.
Let's change the conversation really quick before we shut the show down about the hidden cost of doing nothing. Contrary to maybe some fiduciary obligation, or a barn burner amazing example cherry picked on just leaving it alone. Well, we can even talk about Nucor here. If we never rebalanced and just sat on that growth, which by the way is the vast majority of investors. If you think about when clients come to us before they're, become a dividend investor, and dividend investors' mindset is long term. I'm going to buy and I'm going to hold this position. We're going to rebalance, but I'm going to hold this position and use the volatility of the market to my advantage. That's what an investor should think, because dividend investing plus rebalancing is amazing. Okay? Maybe some cherry picking in there sometimes.
Yep.
But the hidden cost of doing nothing, so you have this one stock that you bought at X and you've never rebalanced it and the yield continues to shrink, okay, on all new shares. The cost of acquisition, every time you're buying new shares, it's now double, triple, quadruple the cost of when you first got into it, and you never took money off the table to go buy something low.
With a much better yield.
Much better yield at a lower price point. The cost of doing nothing could crush your growth of your portfolio, crush your yield of your portfolio, and you're never taking advantage of the volatility of the market. Like the best, like last year, if you look at the market, we had the tariffs. And I mean, the news went nuts. Different sides of the aisles were up in arms, for and against it, on both sides of the aisle.
Yeah, right. Like it
was crazy. I'm not really sure where we've landed on all of that, but the dust has settled. The market's way higher, and all that volatility for a dividend investor was magical.
Yep.
Because the stocks came back, but our stocks really didn't dip that much.
No.
But the volatility of the market was nuts.
It was, yeah.
And that's, for a dividend investor, you want volatility. Like nobody wants to see red in their portfolio, but we all want to buy low.
That's right.
I want things on sale. I want cheap.
Yes.
But then you're like, but I just want to make money. Well, if you want to make money, you want loss in the market.
That's right.
You want loss in your portfolio, because it's that springboard effect where if I have this value and it comes down and I'm buying those shares, like we've talked in, like Dow last year got crushed and now it's a barn burner. And 2 times last year, we were buying more shares. Actually, 2 times in the last 2 years, we were buying more shares. And I got clients going, why are you doing this? Why are we buying a loser? Well,
you buy low,
it's on sale.
And it's bringing your basis down. So instead of your average price being at, let's just call it $80 a share, now you're bringing it down to 60. So your recovery rate, whenever it does turn around, you shoot past everybody else who did nothing.
Yes. That's the beauty of this. Sometimes you get it right. Sometimes you get it wrong. But if you stick to disciplined investing, you will be, and statistically, you'll be much further. So we'll talk about this, the Dalbar study.
Throws it in the face of let's just set it and forget it.
Yeah.
Even with dividends, because, and I'm just bringing this up because I really like this point, especially because almost every one of our clients, the reason they're hiring us is for, if not today, but at some point, they want the income, right?
Yeah.
And by that stock price moving up and you never selling it and going and buying stuff that's cheaper with the higher yield, you're not able to increase your income at the same rate because the cost to buy more shares of that same stock have gotten so expensive.
Yes.
So your income basically stagnates, and then it's not keeping up with inflation.
With mutual funds, it just kind of dawned on me, their rebalancing may or may not be in a specific positions. It might be in sectors. We're talking about rebalancing in specific positions that are strategic to our portfolio. I wouldn't say we draw a blind eye to sectors, but Warren Buffett famously said, diversification is for those who don't know what they're doing. So when you have diversification for diversification's sake, rebalancing might not even work in your favor.
Correct.
We're not looking at our portfolio as this diversified portfolio of dividend stocks. We have a strong portfolio of dividend stocks and we have diversification. But sometimes we'll way overweight something because there's tons of opportunities.
Well, and that's just where the economy is moving towards, right?
Like diversification is probably the last thing we'll look at. We'll look at that, but that's not like the first thing. We have to find a stock in X.
Yeah.
Let's go find the best one. That is never part of the discussion.
Legitimately the last.
Yeah, like the last thing. So, okay.
It's like that, and what is the stock price?
This is the last.
Or the last two.
Yeah. Or we look at our portfolio and we've got some high ones.
Yes.
The first thing I might go is, hey, that's at a 52-week high. Is there anything that's close to that strength that's low?
Yes.
We have done that many, many times. That might start a discussion that leads to a transition. We did that last year with one particular stock. Worked out very well. We'll do that many more times. All right, let's talk about this hidden cost of doing nothing. There's a Dalbar study. If you look back, and this is one of the very rare studies that has, I think, like almost 40 years of actual study now. Because I remember talking about this when they hit the 30 year, and that was 10 years ago. and now they've got like over 40 years of study, and it talks about the psychology of the investor and how often they make decisions, and most of the time it's emotional decisions, and it's not has nothing to do with rebalancing. And when you start throwing in strategic rebalancing, I mean, the average investor that is not a long-term or just a buy for growth, they average it's like less than 2%.
I would say it was 1%.
1%. And these are growth investors because they're buying and selling on emotion.
Yep. Right.
And they're not in it for the long haul. They're in it to win it.
And they're late to the game.
And they're
on
early
buying and selling.
Yeah, right.
But when you're
panicking one way or the other.
When you're a dividend investor and you're buying on reason and logic and planning and strategy, and you've got purpose in what you do, and then you put discipline practices that are forcing logical decisions, not emotional ones. So we're not looking for market opportunity. Like the market's down 3 days in a row, we should rebalance. No. We're looking for misalignment in our portfolio that gets broad enough across our client accounts that's so out of whack, we're like, now's the time. It has nothing to do with market conditions.
Correct.
It has 100% to do with our positions and the last time we traded and where we currently are. And when we do research on our portfolio and we go, okay, this is the way it's supposed to look. I know there's a little crookeds in there. But let's just say it's straight. And now all of a sudden, our portfolio, you start looking at all the positions and they move so wide. We have so much, whatever you would call that. The deck is so jacked that we're like, we need to bring it back to center.
Yep.
And we're about to do it right now.
Yep.
And the reality of that is such a good practice because it's portfolio specific.
Correct.
We're making decisions based on what we own, what we have, and why we have it. The outside noise and markets have no weight on what we're doing. Zero. Now the markets and the movement changes our portfolio, but we won't make that decision until our portfolio is out of weight. And if you look at the Dalbar study, the ones that are making decisions based on that, I mean, the returns are insanely different. I mean, it's like 8-9% different a year. In the S&P, the markets, I mean, the S&P changes every year. But if you just bought and hold, and I'm not advocating this, but if you just bought and hold the S&P with this pathetic dividend return.
But they're at least rebalancing once a year.
They are rebalancing once a year. They average, what,
Same
10%?
for the NASDAQ, yeah.
Our portfolio has been better than that, but it's just 10%.
Yep.
The average investor that's just randomly buying on emotion, 1% or 1.2% for its career. And if they stopped adding money, they'd never make any return, which is nuts. All right, let's close this show down. Any last thoughts?
One takeaway for me is by not rebalancing, you're actually making a decision. Like there's no such thing as the passive set it and forget it, because even by doing nothing, you're deciding to do something, and it's not always going to be in your best interest. So I think the data is there to prove that you're actually hurting yourself more than helping.
I would say disciplined decisions will trump emotional decisions 100% of the time.
Agree.
Yeah.
Cal?
Well, I mean, one thing I would say is just like anything else, pruning helps, right? So if you're successful, whether it's gardening, whatever it is, if you are just letting it run wild, things usually start falling apart or weeds come in and all that. So with the discipline investing of like pruning it out and making that continue to grow and improve, it makes the whole
You
scenario
never
better.
know what you're going to hear on the show. Over
Green
here.
thumb over there.
We got the gardening tips by Cal. That's awesome. I love it. All right, let's shut this down. You're going to shut us out today, right?
Oh, that's right. Yeah. Don't forget to subscribe. And we have a dividend starter kit that you can get by just registering, signing up. Download it. We'll help you out there. We also have a freedom assessment tool that you can use. just make a note in the comment section. We'd love to see you on the next episode.
Hold up. I want to see the. Come on, man.
Stay calm and rebalance on.
Thanks for watching.